We also get in Pranav into the conversation, and we have Aditi Nayar also joining in. Aditi, I'll come back to you. But Pranav, taking into consideration now, the question is going to be with regards to how effective the transmission is going to be and the impact that the banks will see in terms of their financials. What's the view that you're picking up in terms of FY26? How will that entire cycle work according to you?
Right. So I think with the rate cuts and the promise of abundant liquidity, two things will happen. One, we expect growth to improve. I think especially with the CRR cut thrown in, from the current 10% system growth, we expect banking credit to get back to 12-13%. So I think that's the best positive. So we could see a bit of a growth surprise on the positive side for the banks. On the margins, given the abundant liquidity, we again expect a positive surprise on the margins because steady state rate cut should not damage the margins too much for the banks. It's only the transmission delays which will damage the margins, again temporarily. Here, with liquidity being abundant, I think banks will be aggressive in cutting the deposit rates, which means by end of FY26, the net impact on net interest margins might not be as bad as feared. So we're talking about 15 to 20 basis points impact on NIM for the full year in the worst case scenario. So overall, a positive surprise, which is what is right now penciled in by the estimates, and therefore positive in the banks. For the NBFCs, yes, again, the rate cut is always a positive. I think the two things which become a drag is one, what is already penciled in terms of expectations. I think a fairly sharp growth is already expected from these lenders. And second, with the rate cuts being brought forward, it's also seen as an indication that growth needs support, and in case it doesn't come back strongly, then there'll be a bigger negative surprise for the NBFCs than banks. So throwing valuations, impact on the metrics, probably side with the banks at this stage. They offer a better risk-reward trade-off compared to the NBFCs at this stage, especially the large private sector banks.
Now, very quickly, is that a minority view? A lot of people are saying that the cost of funds coming down might actually be positive more for NBFCs. Are you a minority? Are you a contrarian here?
Yes, because we do see the growth risk. I think you will not get both. You will not get growth and margin benefit. If RBI has been aggressive, it's because they are worried about growth.
Okay. Pranav, we'll leave it at that. Thanks so much for joining in. Jayesh, I request you to stay on for a minute because we have to take a final word from both you as well as Katrina. But just welcoming Aditi Nayar in the conversation as well. Aditi, actually we didn't ask Jayesh for his rating, neither did we ask Katrina. But Aditi, I'm going to start with you. You rating this 10, 9, 8 or slightly lower?
Look, as the chief economist of a rating agency that's regulated by the RBI, I'm not going to be able to give a rating. Really sorry about that. But let me tell you what, this was a policy packed with surprises. I don't remember the last time we got so many surprises coming out of a single policy meeting. First of all, the large rate cut, the front-loaded rate cut, and with that, very interestingly, we got the change in stance. Again, cannot remember the last time that the stance changed and changed back so quickly. And then, of course, the CRR cut, which we really weren't expecting. Now, going forward, I think a couple of things are going to be really important. One, of course, how does growth respond? How does the domestic economy's resilience really come through in the next few months, before the next policy meeting particularly? Are there any fresh cues that we have on the table? And of course, how do the inflation readings pan out? So if you would have noticed, we got the reduction in the inflation forecast for the full year, but the quarterly trend is upward. So possibly, I still feel that the Q2 number could end up being lower than what the MPC has told us even today. And if it does, that would be one of the factors that could lead to that final rate cut that a lot of us were talking about. So our view was we'll get 3 rate cuts of 25 basis points each. We've got 150 today. So that last 25, whether it will come through or not, I think is going to be very crucially determined by whether the MPC can further reduce its average forecast for FY26 inflation from the 3.7% that they've laid out today. And if they can particularly have confidence that the Q2 or Q3 number will be lower than what they forecast, then I think in August rate cut may still be on the cards, although with the change in stance to neutral, obviously the likelihood of that at this point in time is on the lower side.
Right. Aditi, stay with us. Katrina, let me come to you as well in terms of taking your closing comments. So overall, taking into consideration, you've already seen a 100 basis points rate cut that has happened in 2025. What would your expectation be, even if you have to be conservative from here on towards the rest of the year? Would it be right to say that no further rate cuts is something that you will bake in, or there is a further possibility as well?
So at this point, we don't have further rate cuts banked into our baseline forecast. Our expectation is that now that the policy rate is sitting at a neutral level, the RBI will sit back and then see how domestic conditions evolve, but also perhaps more importantly, see how global conditions evolve and then determine whether further adjustments need to be made to the policy rate and other levers as well. But at this point, I just don't think further adjustments will be needed. But it will be incredibly interesting to watch, particularly how credit growth, domestically driven credit growth, starts to pick up over the next couple of months and how aggressively banks then follow through, because that will be the key to determine how potent these monetary policy adjustments are. But I think it is certainly good news that because inflation is well contained and on the expected to remain at the lower end of the RBI's 4% midpoint, it does give them the flexibility to move if they need to. But the fact that they have changed their stance from accommodative to neutral does mean that they are signaling, look, don't expect more rate cuts unless conditions really deteriorate at this point.
Okay, Katrina, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time today, as always, by the way. Jayesh, sorry, so I know Aditi can't give a rating, as she rightly said, but is this the end of the surprises, Jayesh, for you, or do you reckon that there is ammo for some surprise? And is a surprise needed, or is a predictable policy regime actually pretty good for growth?
I think firstly on rating, can I give 11?
You can. You most certainly can.
No, I think you know, you look at it slightly, you know, back of the mind. It is a very thoughtful, decisive policy. Of course, as you said, like, you know, everybody was expecting cut now in August. So I think that they've done it upfront. Now, after that, naturally, you have to see the, you know, whether you are, as Aditi said, like whether you remain at 3.7 or you move to 3.9 or you go to 3.6. Even if it remains 3.7, maybe it can still give you some room for rate cuts. So that's something, or maybe if not August, maybe the policy after that, right? So something on that lines very clearly. On CRR also, it's a very, very, very decisive move. You know, one of the things I'm just trying to recollect because I haven't got time to read it, but I didn't say that it's a temporary CRR cut, right? It's a cut. So from that perspective, I think it's also getting prepared, like you are going to move to LCR guidelines. Why do have 2-2 situation? Like banks have always been complaining, we have LCR, we have CRR, why do we need both of that? So I think from that particular situation, you know, you have SLR, LCR, CRR all put together. That is kind of putting burden on bank balance sheet also because it's zero cost. Whereas at the same time, you have, you know, RBI anyway borrowing at 0.25% lower than the repo rate. So that's something, you know, you can always keep a buffer. So from that perspective, I think it's taken a very, very decisive decision rather than going on to debate or should we reduce CRR or not, or you know, or could this be a trend? I don't know. One has to really look at it. Could it be a trend to actually reduce CRR on an overall basis? So I think that's the thing. It's too premature to say that, but it's something I want to look at.
So Jayesh, I'll interrupt over here. We're running slightly out of time. A quick range that you could give us, because the yields have hit the lowest level today since September 2021. What is that range you're baking in from here on, taking into consideration how the bond yields will move?
So we had 5.5% liquidity being abandoned. There is no reason why it should not be below 6, maybe whether it's 580, 590, but that's the number I would look at. Of course, right now there has been some huge demand on the short end. The long end was suffering. If you look at the short end 5 years, anyway at 575, right? 4 years, 5 years. So there is no reason for 10 year to be at 620 or so. And I think there is enough room. But of course, there will be some profit booking coming in, as I said. And that may be another give a month or so. It will slowly trend downwards.
We'll leave it at that. Thank you so much, as always, for taking the time out and being with us on the policy day. Aditi, we won't push you for ratings, but what's the surprise element? Aditi, in a minute, if you can tell us, we need to slip into a break, but final words in a minute. What is the surprise element left for the next policy?
Very little, I think. Honestly speaking, the stance has been used so strongly to signal what's coming that I think there is probably not going to be too much surprise from here on out. And on second thoughts, with the CRR having been cut today, maybe that final rate cut is really off the table unless there are significant downside surprises on growth or inflation coming from here. And on the yields, I actually don't think that 10-year is going to come below 6%. I think 50 basis points of rate cuts have already been built in. And while there has been some down movement today, it's not been very sharp despite the surprise being 50 instead of 25. So I don't think we're going to breach 6%.
Okay. We'll leave it at that, Aditi. Thanks so much for being with us. Really appreciate your time today. And just get a quick perspective as we wrap up the show from Pankaj Murarka, CEO of Renaissance Investment Managers.